Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice or a specific stock recommendation. Them's the rules we have to work with. This week, the headlines have been dominated by President Trump's state visit, and in the financial markets, a lot of comment around the latest interest rate decisions from the Federal Reserve and Bank of England. But as always, there's been plenty of interesting news from the investment trust sector as well. And if you want to keep tabs on all that, we do provide a comprehensive weekly summary in the Moneymakers newsletter, so do feel free to subscribe to that. This week, to discuss the investment trust sector and the wider world, I guess, as well, I'm very happy to say that I'm joined by Peter Hewitt, who has been on the podcast several times before, well known to listeners, and who recently stepped down from active fund management after 17 years of managing the CT Global Managed Portfolio Trust, and several years before that, tracking and having a professional role in the investment trust world. So, man of great seasoned experience in these areas. So, Peter, welcome to the podcast again. Now that you're, as it were, stepped down from the active management role, I dare say you'll have even more to say that you could have done, sometimes not been able to in the past. So we're looking forward to having you on the podcast for several reasons, that amongst them. So let's kick off by just talking about what the investment trust sector has been doing this year. It's been a very lively, volatile year. I mean, we have to thank President Trump for part of that. But tell us what your thoughts are about the way the investment trust has performed this year, both more recently and since the start of the year.
Well, morning, Jonathan, and to everybody else listening in. It has been an interesting year for the sector. I mean, cast your mind back, the first quarter was not great, and trusts did underperform materially. There's all this stuff about, well, Trump coming into power and then tariffs. And then you may remember the 2nd of April, that's when he announced all these very high tariffs on a whole range of different countries. And then on the 9th of April, he announced that they were being paused. And actually, since then, things have performed a lot better. And believe it or not, since then, so that's roughly 6 months, not quite 6 months, because we're speaking mid-September here, the investment company sector index actually outperformed the all-share index. Not by much, but that is encouraging. It's not made up for what was lost in the first quarter, but it is encouraging. And I would say over that period of time, discounts have come in a bit. They could still come in a lot more. The average sector discount is 14 and a half, and it used to be in the higher teens. So that's better. Discounts on companies investing mainly in listed equities are a bit tighter than that, and that's also a positive. However, I definitely notice that the last 3 months have been not tightening any further. In other words, things have stalled. And candidly, my fear, just in the short term, here we are sort of the 19th of September, is that what happened last year might actually repeat itself this year. And if you can cast your mind back, the run-up to the budget at the end of October last year was horrendous for investment companies. There was a complete buyer's strike, demand dried up, discounts widened. September, October were not great months at all. Now we've got budget at the end of November, and this morning we saw an announcement that the budget deficits are much higher than expected. So more gilt issuance, probably pressure on gilt yields on the upside. And, it's just a question of what taxes and how much will be increased in the budget at the end of November. And so that scenario, I don't think is really that positive or encouraging domestic investors to invest in investment trusts. I'm not saying there'll be no investment, but I just think with all the media and the press focus on, it'll be capital gains tax, inheritance tax, this tax, that tax, it's not great. I mean, the underlying fundamentals for UK consumers and UK investors are quite good. Savings ratio is high, and so the potential to invest is there, but I actually don't really think it will happen. due to the run up to this budget. Because it can all be one of these things. When the budget is announced, even if it is bad news in terms of tax rises, once you know what it is and markets can then price that in, you can then move ahead. And actually, the consensus estimates for 2026 in terms of partly UK growth, but more definitely corporate earnings, is quite good in the UK. I mean, 10-11% growth is up there with Europe, only slightly behind America. And yet we're on a kind of PE of 11 or 12. It's gone up a little, but it's miles behind, other markets, in particular the US, where the forward rating of the US market is now 23. I mean, there's some great companies, the tech companies are doing really well, but that's pricing in a lot of good news. So that's the sort of environment I see that we're in just now, Jonathan.
Okay, so I suppose if we look at Trump as well, it's not just over here we've got this uncertainty hanging over us, but I think the story of the US market this year, I don't know if you'd agree with this, to some extent is the reason that the markets have performed so well since April the 9th on the whole is because there is now some recognition that not everything that Trump is going to do is going to go through in the way that he wants it to. There's a bit of a pushback on various things from the courts and even from the Republican Party in some cases. And so that's better than having a world in which you've got absolutely no idea what's going to happen next. So that is some improvement, as you say. And the markets have, as I say, done pretty well since then, but it's been a real roller coaster ride. And who knows where we go from here? That's absolutely right. Looking at the investment trust sector, though, you've pointed out the performance characteristics of the last few months. Do you think that the boards of investment trusts are now, as it were, fully up to speed? Everybody's engaged with this issue of tackling discounts because that has been a big concern. It's now 3.5 years or so that we've had this discount widening. It has leveled out a little bit and picked up a little bit, as you say, from the worst levels. But a number of boards have not been perhaps as fast at dealing with this issue as they could have been. What are your thoughts on that, first of all, as a general proposition?
I'd agree with that. Front and centre, I think, for most boards is how the shares of the companies that they are on the boards of are rated in the market. And I think boards are beginning to grasp it, some more than others. Clearly, some have been pushed into it with the likes of Saba and what's happened there, but there's wider activism going on. And as long as, remember I said the average sector discount's 14. So, for private equity, that might be 25 or 30 or more. For renewables and infrastructure, it's still wide, well out there as well, towards 30. It's not getting worse, but it's still far, far too wide. And even for listed equity companies, yes, there's some doing well, trading round about par or at narrow discounts. But I always think if you're on the board of a trust investing in mainly listed equities, you really don't want to be seeing that trust on a double-digit discount because that tends to open the door to potential activism. So how boards respond to that has been different. I mean, buybacks are still happening, but there's buybacks and buybacks, and quite often you require a quantum of buyback that may be extremely uncomfortable for the fund manager and the board, but if you do want to make a difference to discount, that might be needed. All share registers are different, and so what is right for one trust may not be exactly the best tactics for another. But I am encouraged that it is, I think, a key topic for boards now. But as long as discounts stay wide, it'll be something that, buybacks is the main weapon. But funnily enough, the thing that underlies that is stimulating demand. Now, I said what I said about the budget and that. I think the next couple of months, you're not going to see a heck of a lot more demand into trusts. But looking beyond that, and if we do have a better market next year, I think that is a key issue for boards is how do we stimulate additional demand, whether that be from the retail sector and platforms, from certain areas of private wealth or family offices or other areas? How do we go about that? And I think in that regard, some trusts are addressing that and others still not quite there yet.
I know you sit on the board of an investment trust now. You're able to do that. How do you respond to? I've heard this several times from directors of trusts. They say, oh, well, look, there's no evidence that buybacks actually make a difference in the short term. We brought back all these shares and nothing's happened. And to which the answer is, well, if there's no demand, then you need to do an awful lot of buybacks to get down to some level which is acceptable to make a difference. But you do at least demonstrate that you are thinking about the shareholders and you're thinking about the discount, which is the price that they actually see every day on their screens for the value of what they own. So do you think that virtue will eventually be its own reward? I guess that's the kind of argument you've got to make to people.
Yes, but as I say, buybacks, it's each trust is in their own individual circumstances, but there's been quite a lot of sort of token buybacks. Well, firstly, it's a positive that shares are being bought back. Let's not beat about the bush there. That's good news. But if you actually really want to make a difference to A, your discount, or B, your share register, I think it has to be something that is by a quantum quite a lot bigger and will make the market sit up and take notice. And that's uncomfortable, particularly if it's a smaller trust and you think, oh, well, I don't want our trust to become too small because it might mean that we're excluded from by certain wealth managers, for example, on their potential buy lists. But actually, I think the target you're wanting is to have a much tighter discount. And actually, once you get there, if that can be achieved, and it has been in certain cases, then the market then knows that actually this board are serious about controlling this discount and will provide liquidity if need be, either in a difficult market situation or there's somebody who wants to exit the trust and the board's prepared to buy in those shares. But in doing that, in getting a discount to 5 or 3 or par or wherever it is, that's massively positive. It opens the way, by the way, potentially for issuance in a slightly better market, but also the confidence and the confidence that actually potential investors will then have to invest in this trust if they say, oh, well, maybe it's not quite as big as we would like, but actually the board's on this. We're not going to go to a wide discount. And actually, if we want to sell the shares, they will provide liquidity. That is something to be cherished. And if it can be achieved, then actually that trust is in a better place. Now, the other part of that equation is it's got to perform. And so if your trust isn't performing, that makes it a lot harder. But if it is performing, then actually you could be on the start of a virtuous circle there of tightening a discount, even getting towards par. And then, surprise, surprise, gosh, we're actually getting demand for the shares. So that's how I would see it in terms of, how this could unfold. So yes, it's great that there's trust buying, but I think there's much more to it than just saying, oh, we're buying back 10,000 shares every other day.
And do you think this trend of the sector shrinking is going to continue? I mean, just looking through the announcements that we've had this week, we've heard from a couple of smaller trusts. There's Hydrogen Capital Growth, or whatever it's called, ticker HGEN. They've announced they're intending to do a managed wind down. That's a relatively small trust and recently listed. Premier Miton Global Renewables proposed a scheme of reconstruction. We don't know quite where that will end up. And we've also heard from trusts like Strategic Equity Capital, which is going to implement a tender offer for up to 100% of the share capital. We don't know how that will go down. And we've also heard from Labs, this small recent property company specializing in new healthcare buildings. They're in a strategic review and are also going to be winding up. So is this just a case of sort of mopping up the rough edges of the investment trust sector, would you say? Or is there going to be more action across perhaps larger trusts as well?
Well, I mean, there has been action in larger trusts. Some of the names you mentioned there are all relatively small. And so I don't know the discounts, the ratings in these cases. It may be that actually the boards have decided this is on a wide discount. We're very small trust, no chance of attracting new demand. And therefore, we should maybe just give the money back to shareholders. I mean, just getting back to your original question, Jonathan, about will the sector shrink further? I think the answer is yes. I mean, it used to have 330, 350 companies. It's currently about 290 in terms of numbers, and I could see that easily moving towards 250. And it's in response to the wide discounts that we've had now for getting on for 4 years, actually. And so now is when you start seeing mergers, liquidations, all these sorts of things happening. And I think it will continue into next year. And that's why when we get back to what kind of causes this, it's discounts and ratings. And so if you get a tightening up there of how trusts are rated, then you'll find that there's less corporate activity happening. And so it's interesting that some of the corporate activity has now begun to focus on in the alternatives area, which had been on the very widest discounts. And for other reasons, mainly liquidity of the underlying assets, we haven't seen much in the way of it. But you saw Apax has hoisted the white flag. I mean, it's going to wind up as a company. And you see other trusts, I mean, PRS REIT, I think, was in the process of being taken over, but also other trusts within the sort of renewables area and infrastructure and potentially also private equity. Watch out for some further corporate activity there. Could easily happen because discounts are very wide. I mean, I saw Saba took a stake in SDL Energy Efficiency Trust, which is not one that springs to mind initially as one being potential for corporate activity, but it's on a wide discount, quite a sizable trust. I mean, the underlying that they've got are not easily able to sell solar parks or something or wherever their assets are invested, but that's happening, and wide discounts will cause that to happen one way or another.
Yes, I mean, that's interesting. Actually, PRS REIT, they did announce this week, didn't they? They've been hawking this round for quite a while now, and they've only really found one buyer who is going to pay, I think they've now agreed terms around 115p, something like that, which is a little bit north of where the share price is at today, but not significantly higher. So given the expectations on that one, I think that may be mildly disappointing to some, though it's a big improvement on where the share price was before the new directors came on board and pressed for action. We could talk more about renewables and so on in a moment, but I wanted to ask you about one specific situation and what it sort of suggests about the wider universe, and that is about a trust that I'm sure you'll be familiar with anyway, is Murray Income, which is managed by Aberdeen, another stalwart of the Scottish investment trust world, where the board again is undergoing a strategic review. This is quite a large UK equity income trust, which actually grew quite significantly back in 2020 when it took over the assets of another UK equity income trust, but it has underperformed. Now, we don't know the outcome of that. I'm interested in what your thoughts about that one are, but in particular, some of the discussion around that one has been interesting because people have pointed out, well, it has a particular style which has been very much out of favour. And then the question arises, well, actually, if you're the board, and if it is down to style factors mainly, in other words, you're just doing what you said you would do, and that style hasn't worked, whether you should be prepared to bite the bullet and continue with that style, or whether you actually try and switch to something different. If you remember back in 2020 when this issue came up, something like Temple Bar, which had a very value approach, which had done very poorly for a period, the board bravely decided to stick with that approach and they've been fully rewarded. So I wonder what your thoughts are around that. You know, the question of performance versus style versus what boards should do. How long should they put up with underperformance?
Well, it's a good question. When Murray Income, I think, acquired Perpetual Income and Growth, which is a big trust, I remember that. At that time, the performance numbers for Murray Income were probably pretty good. And it is definitely a style issue. And this is a bit of a generalization, but quality growth companies is what Murray Income invests in. In other words, the underlying companies actually are good businesses. Problem is that the share prices have not performed for a long length of time. And there's a number of trusts. In fact, if you look at a lot of the trusts that are in difficulties at the moment, they've had that quality growth approach. So think Finsbury Growth and Income. You could think kind of sister company in Aberdeen, Dunedin Income and Growth, similar. Smithson, where Saba, I see, have just increased their stake to nearly 15%. And it's a global trust, but similar type of style. And across the board in US markets, European markets, UK markets, the underlying companies simply have not performed in share price terms, even if perhaps their profits and earnings have done reasonably well. And that's definitely hit Murray Income. So that now you've had probably, I'm going to say 4 years are really not very good numbers. I mean, I saw their numbers were 9 points behind the all share year to end June. And yet, coincidentally, City of London, in the same sector, with a much more value orientated trust, was 6 points ahead of the all share over the same period of time. City of London trades at par. Everybody knows and loves it. 59 years of dividend increases. Well done, them. But definitely, it's been a style issue because a fund manager at Murray & Co has been doing it for nearly 20 years and has performed quite well over long periods of time before then. So it's a question of what do you do about the style? How much longer will these companies adopting this style continue to underperform? And I saw Nick Train at a presentation recently. He runs Finsbury Growth and Income. And I could tell his frustration. He does invest in some really good companies, but it's just not been coming through in terms of share prices. And I think one of the things may be the valuations of these companies really did get too expensive 4 or 5 years ago. And gradually and remorselessly, they've been derated. And that derating may still have a bit to go because the portfolios of some of these trusts we've mentioned, Murray Income, Finsbury Growth and Income, Smithson, I'm sure, will be way above what the index average PE to the portfolio is. So I think that's it. And for the board of Murray Income, who it's a big trust, it's nearly $1 billion, they'll probably not want to merge with somebody. They'll want to either continue with Aberdeen, they may decide to, or more likely go with somebody else. Do we actually have a big change of strategy? And of course, this is looking ahead to the future. You just don't know if they're doing it at the wrong time. And actually, you and I are chatting in a year's time or 18 months' time, Jonathan, and you think, oh my word, look at all those trusts with a quality growth investment style. They're now all at the top of the league tables. That's the conundrum for the board.
Yeah, it's a tricky one, isn't it? And we saw some examples of that, as you say, back in 2020 when I think 3 large UK equity income trusts changed managers anyway, and some of them done spectacularly well. I mean, Temple Bar would be the classic example, which is still stuck to a value approach and is the best performing trust over 5 years. But of course, it started from a much lower base. It is an interesting dilemma for boards whether to actually change the mandate or not. And I think everybody will watch that one with some interest. I mean, the other point to make, I guess, about that, and you'll know this, having managed a trust which had an income class and a growth class, income is very much in the news at the moment. I mean, basically, if you've got a decent yield, a lot of trusts are still doing very well. If you look at the list of trusts that are trading at a premium, there aren't many of them, but nearly all of them have an income component, so a relatively high yield. So do you think that's going to continue? Is it just a function of interest rates, or what are your feeling around that?
Well, I think it will continue, Jonathan. The extreme example there is Henderson Far East Income, which has got a yield, I don't know exactly what it is just now, but let's say double digit. It's been the laggard in terms of total return performance within the Asian income sector. But because it's got such a high, and this is important, sustainable dividend yield, that they've actually edged ahead. It's very popular with the retail shareholder base, the platforms, people who invest in trusts through Interactive Investor, Hargreaves Lansdown, AJ Bell, and the rest. I was at a presentation recently that another Aberdeen trust, we're just talking about some Aberdeen trusts there, Aberdeen Equity Income. And that has got a big dividend yield. I'm going to say it's over 6.5. They've
Yeah.
been edging it ahead. Its performance has turned very positively. It's a value-orientated style. I think a really good fund manager, a good stock picker, had a difficult period for some years. Now it's turned. It's got a high and sustainable yield, and they're issuing shares. I think that's great. And there's quite a few other examples like that. And an interesting point, actually, you see more and more trusts adopting, and we're going to have a high dividend yield, paying some or all of it from capital, because in the belief that that is more positive for the shareholders and retail shareholders in particular like that. And so it will be interesting. Dunedin Income and Growth has just gone down that route and said they're going to have a 6% dividend yield. And if you look at what you get on a bank deposit and gilt yields, that is well in excess. But I'm always minded, just have an eye to, in the very long term, the all share index generates a return of round about 7% per annum. Now, in any given 1 year, that might be 25 or it might be negative 15. But over the long run, it's about 7. If you're paying 6% of that in income, you're not going to get that much capital growth. You may get some for a period of time, but again, over the long run, through investment cycles, you probably won't. So you just got to bear that in mind. Personally, I don't think there's anything wrong with adopting that approach. But what you're saying to shareholders, you're going to get quite a lot more of your return via income. And then there is no doubt there is a large constituency of retail shareholders who like that. And the evidence for that is in the ratings for some of these trusts that we've had. I mean, in the case of the Managed Portfolio Trust, our income portfolio yields 6.5. We trade at par, we issue shares, it's popular. And so is there anything wrong with giving shareholders what they want?
Well, it's interesting, isn't it? I mean, I think the latest results from City of London, which you say is the largest of the UK equity income trusts and as well known as the most heroic of the dividend heroes, 59 years of consecutive dividend increases. And the chairman was sort of thundering away about he would never pay a dividend out of capital, sort of over his dead body. It's become a sort of dividing line. While at the other extreme, you say, more trusts are adopting a enhanced income
Well, I mean,
approach.
for City of London, which I think is a fantastic trust, I think the dividend yield has been between 4.5 and 5, generated naturally from underlying dividend income. They've also had the benefit of having significant revenue reserves, and so they are in a wonderful position. It is mainly exposed to the FTSE 100, which has been the better performing area and continues to be within the UK market. So major tick in the box there for City of London. Dunedin Income and Growth had a yield much lower of sort of 3 to 3.5. And that's actually not that competitive now in comparison to what you can get from a bank deposit or other areas. So in order to make themselves more attractive, they're adding some extra revenue, which is actually from capital, to bring the dividend up to about 6% of NAV, given the discount, actually about 6.5% on the share price. We will see if that makes a difference to it. But all you can say there is City of London have just been in a great position. And there's a few trusts there. Merchants Trust is another one that springs to mind, where they've got a high yield and sustainable yield and managed to edge it ahead. But well done, City of London. And that's why it's as popular as it is with retail shareholders. It sells at a premium and it issues shares. And it's a big trust. It must be pushing 2 billion, Jonathan.
Yeah, indeed it is. You are listening to our Moneymakers podcast. We are an independent research and publishing venture and grateful to JP Morgan Asset Management for their generous no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded, with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription Moneymakers newsletter, which provides a comprehensive summary of all the latest news, results and performance data from the investment trust sector, with links to the relevant stock exchange announcements if you want to go down that rabbit hole, and many other regular features including more than 170 in-depth and independent trust profiles, regular market commentary and videos, plus the editor's list of favourite funds. If you never want to miss a thing that might affect your portfolio, do please sign up today at money-makers.co. And if you follow this podcast on YouTube, please do use the subscribe and like buttons. Thank you. So if we go back to the renewables, which are obviously now offering extraordinary yields in a way, I mean 9, 10% in some cases, and are fully covered by earnings in the short term at least. The longer term we don't know. But there's something going on. I blame the Scots for this actually, because the wind isn't blowing as much as it should be offshore. And even if it does blow, you can't always get it into the electricity grid, the power that's being generated because of our crazy infrastructure set up in this country. And they're trading on huge discounts. That's why the yields are so high, of course, because they are trading on massive 25, 30% discounts. And somebody, I noticed one of the analysts pointed out this week that the problem now is the wind has suddenly started to blow a bit more, having been very kind of weak so far this year. But unfortunately, the power prices are coming down because there's more wind energy coming into the grid. So it's a bit of a kind of conundrum. But I'm sure you'd agree. I mean, there have been very disappointing performers this year. The renewables, we all thought they would start to bounce back, and it just hasn't happened.
Yeah, I mean, I agree with you, and it's been very disappointing. I think the sort of wind issue, it does affect power prices a bit in the short term. And I mean, as you know, Jonathan, a lot of the wind farms and that are in Scotland. And because Scotland has such a balmy Mediterranean climate, sometimes the wind doesn't blow perhaps as much as it should do. But don't worry, I'm confident that wind will come back, and pretty strongly in the autumn. But more seriously, again, I attended a presentation given by Renewables Infrastructure Group towards the end of August, actually, in Edinburgh. I think that's quite a well-run company, and they will just about cover their dividend, I think, going forward. But it's been short-term power prices that has definitely impacted the share price there, and it's come a way back. I mean, I think the thing is yielding double digits now. And Greencoat UK Power, big one, that's had a similar type of experience. And actually, just looking over the last 3 months, those two have been two of the worst performers of the whole investment company sector. And so discounts have widened, NAVs have actually started falling. And I think there's an issue as to what the expectations for power prices will be in the medium to longer term. And if that starts to fall, then that will definitely make it harder for some of the renewables companies. I'm not an expert in this area, but all I would say is if I was on the board of one of these trusts, if it's at all possible to continue the dividends, then that is your key way of rewarding shareholders. And you have to hope eventually that discounts will stabilize and you'll start getting some support into these trusts. Because if fundamentals actually did take a turn for the better, these things could perform really, you get quite significant rewards. They're on such wide discounts. But it's been a tricky area, it really has.
I'm looking down the AIC data for this. So there's 9 trusts in the renewable energy sector which have a dividend yield. Obviously, historically, this is based of more than 10%, which is really quite extraordinary when you think about it. But of course, one of the problems is I think that we have this in a number of alternatives. Basically, how you produce the NAV of these things is you plug a lot of numbers into a computer and you project forward and discount at a particular rate. And there are quite a few assumptions in there about power prices in particular. And the interest rates are going up, so the rate at which you discount the future cash flows goes up, and that produces the NAV. And there has to be an issue whether or not those NAVs are actually right or not.
Yes, I mean, genuinely, if longer term power price expectations are for them to fall, then that is not great for the sector because who's going to invest in new wind farms or indeed solar farms if the price you're going to get for the electricity you generate keeps falling and is too low? So I think that's where we are with that sector. It is slightly confusing. It's in the eye of a hurricane at the moment, but undeniably, they are extremely good value. Whether they are value traps has yet to be decided. But again, I'm always interested in what's happening with the dividends. And indeed, they are increasing, albeit nominally 1 or 2%, but they are increasing for the likes of Renewables Infrastructure Group, Greencoat UK Wind, and others. And that is a positive. And that's clearly the boards, as best as they can tell, saying, actually, we think we've got the cash flow to see this through. Time will tell if that's the case, but let's hope it is.
Indeed. And of course, that's without taking into account the broader picture about, well, we know that President Trump had something to say about our net zero policies at the moment and stopping future development of North Sea oil and gas and so on. It's certainly an issue, perhaps, that people might come to a view about. Who knows whether our regime that is pursuing net zero will continue in the same vein, say, beyond the next election. That would be an interesting issue to see. So let's just come back then, finally, Peter, if we may, to, if I can ask you this, as you say, you've stepped back from actively managing the portfolio of your investment trust after 17 years. Is that going to change how you invest your own money? How are you going to be managing your portfolio from here on in? Are you going to be able to do things you haven't done before, or you'll certainly have a more concentrated portfolio, I would think?
Yes, I will, but I've been fortunate in what I've done with the managed portfolio trust is I've had access to some fantastic fund managers. And so I now, and have done, started buying shares in some of their trusts. So, for example, and I've said this for a while, I think any individual investor, unless all you want is income, you should have some exposure to secular growth. So what do I mean by that? Investment companies that invest in underlying companies that have got long-term secular growth, in other words, above the rate of growth of the wider economy. And so that's where you get back to the technology sector, which we should discuss because it's driving the US market. It's probably driving the US economy. The amount that some of these tech companies are spending to upgrade their AI capabilities with data centers. But you look at the best performers in the last 3 months, and Polar Cap Technology, I've got Allianz Technology, have been right up there. And so there is a strong case for having a portion to be decided by the underlying holder, but have some of your holdings there. And the other one, and I think it still remains pivotal for the whole sector, is Scottish Mortgage. I mean, if you just look back at Scottish Mortgage, the fantastic run that it had for many, many years, peaking at over £15 a share in the end of 2021, a great time for the then manager James Anderson to retire, which he did, and then it went back down to £6 a share. That's a big loss of value by the sort of summer of 2022, autumn of 2022. Now you look at it, and it's back over £11. It's made a huge recovery. I think it's very well placed. The private equity companies it's got within the portfolio are really exciting. SpaceX is the big one, but there's others too, ByteDance, Stripe, and a whole series of others. And so I would have an element of a portfolio exposed there. I wouldn't have it all because some of the ratings in the US are very high indeed. And so when they suffer a setback, it won't be a 5 or 10% setback. Just beware, it could be 30, 40% or more. And that will really test you if you're a shareholder. Because if you're a long-term shareholder, you actually might even add to your holding. But certainly don't sell after a fall like that, because these companies are investing in businesses that have got fantastic growth prospects. So that is certainly one area. And then just the really good stock selectors. So take, in the case of the UK, I've got Fidelity Special Values. I think Alex Wright and his team are really, really good stock selectors and have consistently added value over and above the all-share index. Jonathan, you mentioned Temple Bar. Now, it's got a very value-orientated approach, so there will be times in the future it does not perform. But again, there's two really good stock selectors running that for RWC. And I mean, year to date, it's up 24%. I mean, the all shares up about 15 year to date. That is fantastic performance. And also Law Debenture and Lowland, which are both up about 20% this year, well ahead of the market. That's James Henderson and Laura Fall. I mean, they are talented stock pickers. So I would definitely consider holding on there. And one other area I think as an individual investor, you should really consider having exposure to is private equity. We've talked about private equity a lot. In the long term, the asset value performance from some of these companies is top of the pops. It's really good. They've had a flat last few years in terms of their NAV performance, but share prices have been not good because they've gone to very wide discounts. Well, actually, unless we go into a really nasty recession, who knows, we might do, but I don't think we will in the next year or two. You've got some really interesting businesses there that invest in private companies with fantastic growth prospects. And so I got Oakley Capital. I think that is a really interesting one. It's on a discount of 25%. It's just gone in the FTSE 250 index. HG Capital, probably the best of the lot. Fantastic NAV growth, and other ones too. And I think if you want to get exposed to a really exciting part of the UK European economy, consider a private equity trust.
So that's interesting, Peter, and thank you for sharing that with us. I think two areas you haven't mentioned, I'll bring up just to see what your quick thoughts are. You haven't mentioned Europe and you haven't mentioned Asia. Both of those sectors have done very well this year, somewhat surprisingly, perhaps in the case of Europe, not so much in the case of Asia. And that raises two questions. How should you think about those kind of regional exposure in your portfolio, and how far does the strength of the currency enter into your consideration?
Well, it does a bit, and the pound has actually weakened a bit against the euro, and European markets have done actually slightly better than the UK market over the past year or so, and I certainly wouldn't discourage anybody from investing in Europe. The JP Morgan Trust, JP Morgan European, has done extremely well and continues to. It's a great way to play it. You get a good dividend out of that too. I also think you've raised an interesting one. Asia and emerging markets have basically been not in favour for quite a number of years now. And I think we could be seeing that change. I mean, the actual best performing trusts this year have been the China specialists. I'm not brave enough to invest in a China only trust. I think it's very volatile. And there are other non-fundamental things that could happen which might derail you. But emerging markets more widely, there is some decent value and great growth prospects on offer there. And some of the trusts, the Templeton Emerging Trust, the JP Morgan Trust, they've been long-term winners from that area, and they will give you decent exposure. I mean, one I invested in I quite liked is the Mobius Trust, and that invests in emerging markets, but small and mid caps, which have actually been out of favour within emerging markets. But I think there's some really interesting companies there, and it's one to kind of lock away and consider. And actually, just to round off on one thing, Jonathan, which is very important, because I mentioned this in previous podcasts with you, has been the performance of mid and small caps, which has been lagging in emerging markets, been a wee bit better in Europe, lagging big time in America, and also here as well. And I mean, I've just got some numbers here. Year to date, the FTSE 250 is kind of 8 points behind the FTSE 100. Now, it was doing better in the second quarter, and we thought, well, the outlook for the domestically orientated companies here in the UK is improving. And that's sort of not happened. And August and September have been difficult months. And I suspect, given what I started off this podcast saying, it'll not be great in October, maybe up November to the budget. But actually, I mean, we get really down on ourselves in the UK. The UK actually has grown very modestly, but has grown. And I think all we're looking for is a bit of consistency and less volatility from government policy and taxation, hopefully interest rates coming down a little, and inflation is scheduled to fall a bit in the UK next year. And that's where you'll see some smashing performance, is from UK mid and small caps. But it's been nirvana delayed, and it will test patience. But that's not an area I'm giving up on. I think you've got some very interesting potential next year. And so I would just throw that out there for the audience.
Very good. So thank you, Peter, for sharing your thoughts again this week. I hope to see you back on the podcast again soon. Liberated as you are, if that's the right term, perhaps it isn't the right term, from your full-time...
Jonathan, can I just come in here? It's very important, because you've missed the topic that I'm sure all the listeners are listening to, is what is happening to Scottish rugby.
Yes.
And all I'll say is I became a British rugby fan over the summer and was delighted to see a good contingent of Scottish players clearly driving the British Lions to success in Australia. So we're now facing a November series in Scotland where they're going to play the All Blacks. I think we move on to the next subject there.
Well, we'll all hope for a good result there. You're absolutely right. I mean, it must be a while since the Lions had more Scottish players than Welsh players in the team. I think that would be quite something, yeah. So that's a feather in your cap. And personally, as a long-time follower of Bath Rugby Club in the Premiership, I'm delighted that the Scottish standoff Finn Russell has been instrumental in guiding us to the title this year. First time for about 30 years, I think. So here's to Scottish rugby. Very good. So that was Peter Hewitt, who just recently stepped down as manager of the CT Global Managed Portfolio Trust. And we'll be hearing from him again in due course.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.